The ECB just cut its benchmark interest rate for the first time, even though consumer prices aren't yet back at their target, and more recent data isn't at all friendly to their projections. The Europeans weren't the only ones. Yesterday, the Bank of Canada also cut rates, even though Canada is in basically the same boat as Europe. Consumer prices are still well above target. It doesn't matter. Cut them rates anyway. So why are these central banks apparently rushing to cut rates after pounding the table over uncertainties about inflation risk for 2 years? What does this hurried pivot mean for interest rates around the rest of the world? There's a simple reason why inflation, as central bankers define it, is suddenly less important to central bankers. Remember, for 2 years, they've been saying it was the most direct threat of our lifetimes, and now, oops, sorry, everything about consumer prices will be just fine? To understand what has changed, we have to take an uncomfortable journey into the confused and tortured minds of central bankers. Essentially, we have to decode their interpretations of data and events in order to see what they see, in order to try to make something useful out of it. So we have to remember how central bankers operate, and we'll start with the ECB. The ECB believes inflation is a combination of expectations as well as the Phillips curve. So wage growth and labor is at the center of everything they think about when they think about consumer prices. Tight labor markets, it stands to reason, it sounds plausible, that a tight labor market would mean competition for workers, therefore businesses have to pay higher wages, and higher wages get passed on to consumers in the form of consumer prices, and there's your inflation. It sounds intuitive, it sounds plausible, but there's absolutely no evidence that's ever really the case. In fact, there's really no relationship between, say, unemployment rates and consumer price numbers. But no matter, since central bankers don't have a working monetary theory about inflation, which they should because they're supposed to be central banks, because they don't, They gotta stick to something. They gotta pick some theory and run with it. So they run with the Phillips curve along with expectations. Remember, this is an important part. They always believe that if you believe that consumer prices are going to get out of control, then consumer prices will get out of control. So every time that consumer prices are above target or elevated compared to some type of perception, that's a problem for central bankers using expectations theory. So again, why are they in a rush since consumer prices aren't yet at their target? And more so, as we'll see in a moment, in Europe as the US, it looks like consumer prices are acting sticky. Furthermore, recent data from Europe suggested that wages are acting sticky as well. The latest data from Eurostat on hourly labor costs for the first quarter of 2024, those accelerated to 4.9% year over year from 3.3% in the fourth quarter. And they had been 5.2% in the third quarter. So they dropped down, they decelerated sharply in the fourth quarter, then accelerated sharply in the first quarter. And now the Europeans are saying, and as Christine Lagarde did at her press conference today, oh, never mind that. We've been laser focused on this particular wage data for a couple years now, but now all of a sudden we're saying ignore it, even though it just accelerated to among some of the highest numbers in the entire series. The same for wage growth. Wage growth was up 5% year over year in the first quarter, sharply higher than the 3.1% in the fourth quarter. Again, they told you to focus on this weight. We're focused on wages. And when wages decelerated in the fourth quarter and that data came out, they said, see, we're all good on wages. And then wages suddenly accelerate sharply in the first quarter and they say, no big deal. Something has changed here. And it's not just wages. It's actually the consumer price numbers and the ECB projections of consumer price numbers that are increasingly a problem. In her press conference today, ECB President Christine Lagarde admitted the Eurosystem staff has raised their consumer price outlook for the next couple years. She said the latest Eurosystem staff projections for both headline and core inflation have been revised up for 2024 and 2025 compared with the March projections. Staff now see headline inflation averaging 2.5% in 2024, well above the 2% target, and still 2.2% in 2025, before finally 1.9% in 2026. For inflation excluding energy and food, the core rate, staff project an average of 2.8% in 2024, 2.2% in 2025, and 2.0% in 2026. And the reason they've revised upward their projections is because recent statistics show that consumer prices appear to be sticky in Europe like they appear to be in the US. To be clear, I don't think consumer prices are sticky at all. I think we're heading solidly into disinflation, and what's happened is oil prices have interrupted that process. But we're thinking about these things from the perspective of central bankers. And so central bankers see recent consumer price numbers come in that seem to be plateauing at well above their target. That's an inflation problem for them. Except now, something has changed. So we look at the latest HICP figures from the month of May, the flash reading that came out not long ago. That was 2.55% year over year, faster than the 2.36% year over year in April, and still faster than the 2.41% in March. And just like the US, you look at the European HICP, going back to last October, it seems to be flattening out at around 3%. So all the fears and claims and uncertainty about sticky consumer prices that we hear in the US, they're there in the data in Europe as well. But Europe says, nah, we're not really that much worried about it. Again, going back to the press conference statement, Lagarde said, at the same time, despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated, and inflation is likely to stay above target well into next year. And so you have to ask this question. So what has changed? For the past 2 years, they have been saying over and over again, consumer prices are the biggest threat of our lifetime. We need to get consumer inflation back down to the target and do so as soon as we possibly can. And here we are in the middle of 2024, consumer prices aren't really near the target, especially the core rate. And while they've made some progress, their own projections, which were revised upward, say that they're not going to hit their target for another 2 years. So how can they be cutting rates here? And the answer that they're giving us is complete crap. What Lagarde said was, we're now suddenly more able to forecast reliably than we were before. Seriously, that's what she said. She said, suddenly the staff projections are more reliable. We can look at these numbers and feel confident in them. We weren't confident in them before, but now all of a sudden we are actually confident in our projections. Answering a question at the press conference, she cited the reliability and strength of these staff projections, and she said, it is on the basis of this reliability and solidity and robustness of those projections that we have made that decision to actually cut. She didn't say how they've changed their projections or the models in which they used to make those projections. She just said suddenly they're more reliable, which raises a whole boatload of questions because the Federal Reserve, for example, uses the exact same models that the ECB does. And the Federal Reserve, if you've listened to any Fed officials recently, what have they said about inflation? We aren't confident. We have these projections, but we're not sure either. Consumer prices appear to be sticky, and using our models, which are the same as Europe's models, we aren't thinking they're reliable. We aren't thinking they're any better than they were before. So what the hell is going on here? And it's really clear and transparent what the Europeans are up to. Essentially, they're making all of this up, this reliability and projections all of a sudden, because the rate cut had to happen. They had to give a rate cut even though consumer prices, according to their terms, still appear to be sticky. The projections say they're not going to get back to target for 2 years, and yet rate cut anyway. So the reason why they cut rates despite consumer prices behaving as they have is really pretty simple. They are more and more concerned about the economy. And they're more concerned about the economy in Europe even as it has hit a little bit of an uptick in the first part of this year. But that in and of itself actually raises more alarms than it does to make it seem like the economy's heading toward recovery. What I mean by that is we saw this last year. Europe's economy in the first part of last year started to pick up and everybody said, okay, here's the recovery. We had a big downturn at the end of 2022. Disinflation started to show up and now the economy seems to pick up. Remember the German chancellor said we aren't going to even have a recession in Germany because things look like they're turning around. And then they didn't. For an entire year, Europe fell further back into recession. It wasn't a sharp recession. It wasn't a deep one. But worse than that, it has been exceptionally prolonged. And so from the European perspective, you've got this this familiar pattern where things look good in the first part of the year only to disappoint and roll over in the second part of the year, keeping the economy stuck in what they called stagnation. What Lagarde said at a press conference was, after 5 quarters of stagnation, 5 quarters, it's not stagnation, that's putting it kindly. 5 quarters of outright recession, the euro area economy grew by 0.3% over the first quarter of 2024. The services sector is expanding and manufacturing is showing signs of stabilization at low levels. So again, they see this uptick, but they also are aware that last year we saw the same uptick in Europe and it ultimately failed. So rather than risk this one failing too, their thinking is, well, if rate hikes were the reason why the demand got dampened last year and the nascent recovery trend was short-circuited, then maybe if we get a rate cut in here, maybe 2 rate cuts really quick in the middle of 2024, that little limited recovery and uptick that we see so far, maybe that will have a chance this year in a way it didn't last year. So they're kind of throwing darts here, hoping that a rate cut will be all the difference in 2024 in a way that there weren't any rate cuts and there were only rate hikes in 2023, leaving the European economy to further recession. So they'll even risk declaring premature victory over consumer prices. Again, I don't believe they are, but they do in order to try to get the economy out of its recession. And there's reasons why they want to do that. And there's some urgency to doing that, which brings us back to why they would overlook all of these less than favorable consumer price estimates and data and everything else, projections and everything else. And the reason is risks across the rest of the global economy, some at home, but really across the rest of the global economy, aren't going in Europe's favor either. Back to Lagarde. The risk to economic growth are balanced in the near term. They're balanced because Europe's already in recession, but remain tilted to the downside over the medium term, even though Europe is in recession. A weaker world economy or an escalation in trade tensions between major economies would weigh on euro area growth. In other words, China, the United States, Japan, basically everywhere else. What was supposed to be a reflationary and rebounding 2024, led by China primarily, coming out of its funk at long last, due in large part to massive doses of stimulus from Beijing, is turning into, holy crap, China is only getting worse in spite of all of the fiscal and monetary stimulus that the Chinese authorities have introduced. So you're thinking in Europe, which is a huge, huge producer for China, this isn't actually good. This means that there could be more downside pressure from China. Not just China, the United States. All of a sudden, we're seeing weakness proliferate all around the U.S. economy. What are we hearing from multinational companies? The U.S. consumer is struggling, but they're not just saying the U.S. consumer. They're also saying the same thing about European consumers. European consumers have been stuck with high price gains as well as a recession for longer than the U.S. consumers have. So there is strain coming from the corporate sector. All sorts of negative signals that 2024, which was supposed to be moving in the right direction, might actually be moving in the wrong direction. So if you're Christine Lagarde, you're thinking, well, maybe I need to cut rates really quickly here, if for no other reason than to introduce some positive psychology that wasn't there last year. And hopefully that will be enough to help offset the risks of an increasing downturn from China to the US and everywhere else this year. Forget about consumer prices. Our problem is taking this shot to try to get out of recession. Recent economic data in Europe has not been encouraging, which I'm sure has been one of the justifications that European officials are going to be using to ignore consumer prices. Yeah, our forecasts are much more reliable. Yeah, whatever. In other words, the weakness is showing up again, which raises the chances of another false dawn this year already. European retail sales, which came out just today, those were down 0.5 percentage point in the month of April after being up in March. So European consumers, which have been beaten down really badly over the last couple of years, they're still being beaten down because they're still paying a little bit more to get a little bit less, which is the recipe for ongoing recession, not getting out of one. And one last factor that the European Central Bank in particular is sure to have focused on: bank credit, bank lending. That's something I've talked about quite often because European bank lending, like the European economy, has been stagnating, which really means contraction, ever since October and November of 2022. Without an increase in bank lending and credit from European banks, it's going to make the European recovery possibility that much more dim. So maybe a rate cut to try to jumpstart European credit, to at least get demand going, although there's not really much that would do for supply. That's a whole other topic. But you can see where the ECB is coming from. You can see what they're thinking. European credit is an anchor on the European economy. Maybe we need to help turn it around whatever way possible. Maybe a rate cut will signal to European banks that we're being more accommodative, as if European bankers don't know that it's not accommodation, or that the ECB is all just smoke and mirrors psychology. Because that's, at the end of the day, what this is all really about. It's not about the Phillips curve. It's not really about consumer prices. It's not about the reliability of forecasts or the increased reliability of forecasts. It's about trying to turn things around before they really get into bad shape for this year. So what this means for the rest of the world is pretty simple. Central bankers are going to start cutting rates because they're seeing consumer prices come down enough that they can get away with declaring victory. They can get away with lying to you about, hey, we told you inflation was the biggest threat. Now we're saying, that's not that big of a deal. They're trying to do something to really change things up in the economy because this year is already turning out to be a major disappointment. We can see signs that it looks a lot like last year, the false dawn of 2023 being repeated in 2024. So central banks around the world, we already had Switzerland, we already had Sweden, now we've got Canada, now we've got the ECB, trying to do some rate cuts as a psychological jumpstart to an economy that isn't going in the right direction. And what that will mean is as interest rates go lower from benchmark policy rates, there's going to be pressure on the Federal Reserve to cut rates too. In fact, that was something that the Bank of Canada's governor, a fellow by the name of Tiff Macklem, you got to love that name. There's limits to how far we can diverge from the US, and we are not close to those limits. So all the central bankers around the world are going to be pressuring Jay Powell to cut rates too, meaning get the Fed out of the way of the market so rates can go lower in the marketplace. And the reason they think that is because they believe that interest rate differentials, and especially policy differentials, are the reasons why their local currencies are so weak against the dollar, when that's not the case at all. But remember, we're looking at all this from the perspective of a central banker. So there'll be more pressure on the Fed to cut rates, and the Fed is going to listen to that pressure, which eliminates one more hindrance to markets pricing everything on a fundamental basis. So quite simply, the central bank in Europe, like the central bank in Canada, has set aside that inflation crusade that they used to say was the most important thing ever. Forget that now. We've got better models, even though they're the exact same models that we're using before. So now we're more confident in our ability to forecast consumer prices. Bull. The economy is weaker and weakening. And they're going to try to use an interest rate cut psychology in order to boost the economy at a particularly important moment, a critical moment, where rather than rolling over into the summer and the rest of the year like it has in previous years, they're going to try something different to see if this one might actually stick. It's not that the downside risks over the intermediate term are still tilted to the downside. It's the downside risks today. And that is why the ECB basically gave up on their inflation fight and said, yeah, we're going to cut rates because it's not really about consumer prices. The balance of risks, even as central bankers see them, have shifted to the weak economy. I mean, it is kind of funny here. The Fed and the ECB use the same models, and ECB now says they're more confident in them, while the Federal Reserve has said we have no confidence in them. It's really all about circumstances, and those are what we talked about in the video link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.